man. This is good, man. This is great. Let's do it.
We are not talking about the Cubs, but it is. Hey, man, the analogy works. Okay. Buying a down market is what we're talking about today. We're going to talk about a couple different asset classes, which is the best market to buy when it's out of favor and what you can expect when buying a down market. We're going to cover it all. But I like that you bring up the Cubs, though I think it's maybe a little too early to be buying low on the cut. You ever hear the analogy, my friend, of catching a falling knife? It's like that knife has dropped like 10 inches and it's got 10 feet to go with your Cubby Bears there. But it's the same.
11 game losing streaks. I mean, I think we're in the ballpark.
But it is a great analogy in that, like, it works with markets. It works with sporting teams. It works with popular culture trends. Like, one that I always love is I'm a pretty decent Grateful Dead fan, but what I really appreciate about that band and that brand is that it's gone through several cycles of being extremely cool and being the least cool thing you could possibly be interested in. Now on an upswing again of coolness, but like 90s before Jerry dies, they're like playing these just like gross stadium tours, and like everyone's like, oh, if you're into the Dead, you're like a loser. This is not cool. And it just like, it does go through that. And markets have the same cyclicality to them, where it's like everybody, the energy sector is a good example of this, where energy got beat up for years and years and years. And just when everyone was like, these energy companies are literally going to zero, it's over with, you start to see some sunlight in there and those stocks start to move higher. I don't know if you have any other analogies for what we're talking about today, but
Crocs.
there is.
For some reason in my head, Crocs is in my head for some reason. And that's another interesting example. I mean, that's true. I mean, people were just ridiculing it for a while there, right? I think there's a Time magazine cover that talks about it was like one of the worst inventions of all time or something like that. Mm-hmm. And look at the resurgence it's had over there. I remember when it started last summer and you're hearing about Justin Bieber and Bad Bunny is like teaming up with it. And it's like, what? And now look where we are. I mean, people got a little bedazzled stuff in their Crocs. It's a trip.
They're called giblets, first of all. Second of all, it wasn't even 3 months ago that I was looking to spend $100 on Grateful Dead Crocs collab. And so you're right on it with Crocs, Grateful Dead, whatever you want to call it. Those brands kind of having a moment right now after being written. I mean, and it's funny because society is as such right now that you can buy stock in Grateful Dead the same way that you could buy stock in energy. Like those T-shirts from Grateful Dead tours in the 60s, 70s, and 80s, you probably could have gotten them for nickels on the dollar of what they're worth now just 10 years ago. And that's exactly what we're talking about. Maybe a shorter term basis and maybe more traditional types of assets. But it's the exact same thing with buying a stock market or buying crude oil as it goes down to zero last year. And everybody thinks crude oil is done. And political opinions aside here, because I think a lot of people could glean where I go on this type of conversation. But a lot of people talking about, non-renewable resources are going to be over with. Crude oil is going to zero. And one of those futures contracts did go negative. But it is this idea of like, when there is the greatest fear in a market, it's probably the best time to get into that market, or when it's the least cool, probably the best time to get in. And we've seen this as recently as Tuesday of last week, where the stock market sells off 2, 3, 4%, and the buy the dippers come in. And it's all part of the same idea here. Stocks moving lower, fear coming into the market, but inevitably bouncing back.
Yeah. And, all jokes aside, we make these great analogies, and I do think they are great. It's a lot easier to hold on to Crocs for the last 5 years or hold on to your feelings about the Dead, over these last however many years. You can hold something like that through the peaks and valleys. Whereas, it's a little harder to,
Sure.
be in oil right before that dip, and it's making that large dip. How do you, maybe you got into it beforehand. How do you manage that situation? Or, SM75, say you were in that before the dip. How do you manage that situation, right? So there's one situation where you're already in it and you're having to deal with those feelings, or, the situation where you don't have a position and you're looking to buy the dip. How much of a dip is a good buy, right? And so it's interesting because when I think about this concept, for me, it takes me back. I feel like when I first started to hear it was around 2009, 2010. I mean, those of us who were trading in '08, you just knew the market was over forever because you just saw so many venerable companies get rocked. I mean, again, I always go back to this, watching Bear Stearns go from like I mean, it'd be like watching Goldman now go to zero. That's what it felt like at the time. And so you see something like that, you feel like, okay. And then you see it happen to AIG, which, for all intents and purposes, when I first started, that's another company that was like, this thing is rock steady. And all of a sudden that's getting hit every day. And so in 2009, every time the market was falling, you're like, okay, this is what's going to happen. I'm prepared to wait for this to continue to fall. And when it, instead of falling, 10%, it falls 4% and then bounces back. I feel like that's when, I don't know if that's when it started, but I feel like that's what I remember people starting to talk about, buy the dip. Sure. And so that's kind of where that concept comes from. But it does create good opportunities at times, right? Like we're not in those time periods anymore. We are in time periods where you're going to see a reasonable drop in something and you're going to look at opportunities to probably buy it because, like you said, there is some truth to it. When people are fearful, those are good times to look for opportunities to buy.
Yeah, absolutely. And what's really nice is that we are presenting several asset classes here that can give you these opportunities on any given day. Like you just have to look for them and stop. So many people get caught up in this like, oh man, like I wish I bought that back in 2009. Or I wish I bought, cryptocurrencies 5 years ago. And it's like, move that out of your mind and look forward to all of the markets that are either out of favor this minute or could fall out of favor in the next couple of days to weeks. These things constantly present themselves. Look backwards for like examples and expectations. Look forward for these opportunities because they exist. Now, you hit a good point there, Jermal, which is like, well, if I use the wrong products, I could get in too early and get hit before you see a market that's down, bounce back. And also, if I don't have the right expectations, then I either, get in too early or I don't take a loss on maybe something that I should before being able to buy that market further down. And so that's what I want to cover here today. We've got the small products. We've got small stocks. We've got small crude oil. So that you're working with products that aren't those large traditional futures that could take you out in a matter of minutes or days. So we feel you have a better suite of products there. Now let's look a little bit at that expectation piece so that maybe you don't get in too early, or even if you do, or maybe the opportunity that day isn't there and you buy a down market and it doesn't bounce back. Where should I be getting out? Where should I be getting in? What market should I maybe avoid? I know you looked at this with our mutual friend, Peter Momat. And what did you take away from the fact that you've got all the likelihoods across the board of a positive close the day after a $1 dip, stocks, interest rates, metals, and crude oil, pretty large variance from one asset class to the other?
I mean, I thought this was astounding, man. I mean, again, keeping the caveat in mind of the time period that we're looking at from, the beginning of 2020 till now, but still, sure. I mean, you have four very different products, in reality that all have a greater than 50% chance of bouncing after, a day after a $1 dip. I think that's pretty amazing. And again, we're not talking about, it's just still amazing. I mean, it's just, there's no real way to put it. But, so this gives you an idea of the ability to, possibly buy dips. Now, again, I would say the best thing about it and best thing about tasting mechanics is understanding being small when you go in as opposed to big, because I got to tell you, like, it's not right or wrong, but just as working at a firm, a lot of times, you're trading large. And so when you see a dip, and it comes to the point where you feel like it's a good time to buy, you usually go in big with the idea of you're going to be able to hold on to a loss for a little bit. So not having to do that when you do go in small to buy a dip, it's a lot better, but even with this shows you greater than 50% chance. That's pretty amazing.
And greater than 50% chance across the board here, and significant edge in some of these markets. And yes, it's only the start of 2020 until now, but keep in mind that March and April of 2020 were absolutely awful for the stock and interest rate market. So you've got a lot of data points in there of a really down market, still seeing those short-term bounces the next day. Also, you have data points in there for crude oil literally going negative in this database here. So to see those positive, greater than 50% numbers, great. To see 65% in stocks, 60% in metals, and even 54 in interest rates, really nice. Now, I want to give you some numbers that maybe you haven't seen yet, and this is going to be your average move in all of these after these dips. So you've got the positive percentage, you've got the edge in your favor from a likelihood perspective. Now we want to look at what you can expect. Is that expectation for the next day, that average move, going to be positive in my P&L if I bought that down market? And then what is the wiggle room around that? You might be interested to see that actually the most upside was seen in interest rate markets here. And you actually saw a crude oil market, and this is probably owing to those sub-zero prices, that even though the likelihood the day following a dip was north of 50%, the average move is actually 13 cents lower, given all of those huge moves lower. What say you about some of these ranges after dips?
Yeah, I guess that makes sense with the oil because of that really outsized move there. But this is interesting. And so what do we say? So that's standard deviation plus or minus $1.51 on SM75.
And those numbers, as you died, I know it's a lot. I hate doing this.
We can break it down right here in front.
Exactly.
You're the teacher. I'm breaking it down with you. We're doing it with everybody else. No, this is good.
That's a good analogy, but I feel bad about that analogy because it is like, oh, I crunched these numbers. I've looked at them for days, and now it's like I'm putting Jermal on the spot, like digest them in 60 seconds, go. But what's really interesting to me is the standard deviations let you know, okay, a $10 move is the average move the day following a dip in stocks, or 10 cents in the futures price there. Now, what can I expect to make on top of that? And what can I expect to lose if this doesn't go in my favor? It's the 35% of the time where I lose on buying a dip. And it's about $1.25 to $1.50. And so this lets me know that if SM75 is at $75 and it dips down to 73 in a given day, and I buy those 73s, what can I expect the next day to either take a loss on or take a profit on, so that I don't either get caught in a really down market or I don't get too selfish and expect too much upside? And it's about $1 to $1.50. That's that standard deviation letting you know. Now, the interest rates has a better average move, a better bounce potential there, but a similar standard deviation as well. So if I buy that S10Y that's down from 14 to 13 bucks, if it gets down to 12, then it's like, all right, that's the move. I'll take my loss there. That's my expectation. And then also if it just bounces back to around $14, that's a good place to take my profits. Does that all make sense to you?
That throws me off a little bit. The rate, the plus or minus $1.50 on the S10Y.
What's that?
That's the only one that throws me off. It's the standard deviation is plus or minus $1.50.
So yeah, essentially that's letting you know that if that market drops from 14 to 13, the expected range for the next day is $1.75 higher and $1.25 lower, given the 25 cents higher average move and then the $1.50. So essentially, market drops from 14 to 13. I buy those 13s. The next day, the range is projected at 11.75 all the way up to 14.75. Right. And so that's what that and more, that's like the hard way to kind of look at it, like the real like numerical way to look at it. But what it's more telling me is that like stocks, interest rates, and metals both have a solid positive average move, and the standard deviation isn't wild. Like right. If the average move was like $10 higher and the standard deviation was like $1,000, it'd be like, whoa, that's a lot of risk for me looking for $10. Here it's 10 and 25 and $3 average moves where you're risking $99 to $150. Crude oil is really the sketchy one of the bunch, given that it's got a negative average move after a big move lower, and it's $230 worth of standard deviation following one of these down days. That's just like really wild, really volatile, and it's not even in your favor. Does that make a little more sense? Yeah, absolutely. And again, I mean, the crude, like we said, it's just because of the wild move that we saw. I mean, the historic move, if you will. So that's understandable. But no, this is good data, man. I mean, that's
it shows you the idea of being able to buy a dip and what the odds can be potentially in your favor.
Sure. And so this is where it kind of concludes here. Stocks and interest rates, and even metals to a point, but maybe a less consistent average move following a dip. But the question becomes like, do you want greater potential? Because crude oil does have the potential to bounce back $2 or $200, but $2 in terms of those futures prices, whereas stocks and interest rates only have the ability to bounce back, $100 or $150. So you have greater potential, but you have a way weaker consistency in that trade. And so I mean, the decision's up to you, but I tend to side with some of those stronger foundations, stronger consistent trades in buying a down stock market or a down interest rate market relative to some of those commodities that are a little wild.
Mm-hmm, mm-hmm. I'm not gonna lie, I'm still on the other page. I'm thinking, which one am I gonna trade the next time they all go down? Seems to me rates. That's where my head is at. You know what I'm saying? I'm already, you got me focused on the trade, man. That's exactly what this is about.
All good, man. I will give you plenty of time here to digest those numbers.
Big dip. I'm in, dude.
Absolutely. I mean, that's why Pete and I talk about that interest rate market way too much. But it's because it's got some of those great numbers to back it up. And it's truly a unique market in there. Either way, Jermal, thanks so much for joining us here today. And thanks for diving into all this stuff, man. Take some more time to digest those numbers. A lot of data, like thousands of data points went into that stuff. There's a lot of stuff to digest there in buying a down market. But I'm glad that everybody has more expectations around it.
The one last data point we needed on there is the plus or minus for Cubs next year and their standard deviation on wins. that's what we just need that, but you can do it for the Sox too. You can do it for the Sox too for next year. It's cool.
Well, I have a feeling that your Cubbies are going to look like crude oil and my Sox are going to look like interest.
They're looking like crude oil right now. See, that's the thing. We're having the outsized move now. Okay.
That's exactly right. We'll crunch all those numbers and more for next week's episodes of The Leap. Thanks so much for watching, everybody. We'll be back in a second with Splash into Futures coming up next.